The government, rather the central bank, has recently unveiled a new base rate that will be used in pricing the bank loans going forward as it seeks to increase supply of private sector credit and mortgage finance in the country. But how exactly does this affect you? Well, here's how.
For years, Kenyans have been subjected to high lending rates that are loaded with numerous hidden costs, making loans expensive. But that is soon coming to an end after the central bank rolled out the Kenya Bank's reference rate, KBRR. The base rate will seek to create a transparent credit pricing framework, making banks disclose what they load onto interest rates and giving borrowers the options of shopping around.
The advantage we have now is that all players will be pricing off a common reference rate that each consumer can identify with.
The 9.13% KBRR is computed as an average of the CBR and the 91-day Treasury bill rates and will be reviewed every 6 months, barring any drastic change in conditions. Banks will now be expected to price all loans using the formula KBRR plus K, where K is a premium that will be added based on the bank's cost of doing business and the borrower's credit profile.
If you are a very risky borrower, you might be given higher margin, say 6 basis point above that, so you borrow at 16. But if you are less risky, you could be given 2.
But to further increase transparency, banks will also be required to implement the annual percentage rate pricing mechanism, or APR. This will require banks to disclose the total cost associated with procuring a loan. This includes the repayment schedule, the interest rates, the bank charges and fees. Banks will also be required to reveal all third-party costs, including legal fees and government levies.
A bank may have an interest rate that is lower, but on a total cost basis, it could be higher. So the APR is now the number that will be able to incorporate all the costs and bring a number that the consumer can be able to compare across the various credit providers.
But even as the country anticipates a more transparent and competitive loan pricing mechanism going forward, experts admit that Kenya is still a long way from hitting the single-digit lending rate target set by the government.
Other than making the whole pricing process transparent, I'm not sure there'll be much in terms of benefits from that.
Cost of doing business in general, the cost of deposit in the market, all those affects the interest rate effectively. So if you tackle one and leave all the others, it will not be effective.
Adelaide Changole, KTN Business.